Good morning. I'm Tim Gerdeman, Vice Chair and Co-founder and Chief Marketing Officer of Water Tower Research. I'm being joined today for this special edition of the WTR Small Cap Spotlight podcast by my colleague Dmitry Silversteyn, WTR's Chemicals and Materials Technology Equity Research Analyst, where we'll discuss his key takeaways after attending the PDAC conference in Toronto, Canada last week. Dmitry, thanks for joining us today.
My pleasure, Tim. Thank you for having me again.
Just to kick things off, Dmitry, tell us about the PDAC annual convention that took place last week in Toronto, and how robust, speaking of which, how robust was the attendance, and was the general mood of the exhibiting companies and convention visitors upbeat, downbeat, or somewhere in between? Also, what were some of the important topics that seemed top of mind as you talked to attendees, please?
Sure. So PDAC, it's an acronym. It stands for Prospectors and Developers Association of Canada. It currently represents about 8,000 members around the world, and it works with members and stakeholders, helping the industry to access capital, find land, find skilled professionals, and ensure responsible mineral exploration and development. Its work really centers around supporting a competitive, responsible, and sustainable mineral sector. And it's a Canadian-based organization, but as I said, it's global in nature. This early March convention is the biggest event that this association holds. With respect to attendance, there's hundreds of companies that attend, particularly the investor side, because there's an investor and then there's an expo side of the business. But on the investor side of the business, these tend to be both major metal miners, as well as refiners and processors, and smaller prospectors, developers, and junior miners. So you have a really nice mix of established players, new and emerging players, and what I would call the wannabe players. But as I said, there's hundreds of companies, mostly public. There are some private ones that may be looking to raise some capital or find a strategic investor, but most of the companies presenting, or not presenting, but exhibiting at this conference and expo are public companies. It's usually a very well attended conference. This is the third time that we've gone to this annual conference. And I would have to say that compared to previous 2 years, this one seemed busier. And talking to people that got there Saturday night and were in the facility on Sunday, which was I got there Sunday evening, but the conference started on Sunday kind of midday, and people were saying that while usually an empty day, was actually very busy, and there were a lot of conversations already taking place as early as Sunday. So it does seem like the interest in the space is there, and companies are trying to hustle and come up with capital, come up with partnerships, find relate and establish relationships, and overall it was I think it was, like I said, it was busier than last year and very, very active. I mean, it's hard to get through those aisles sometimes during the peak hours of the conference. You've asked about what were some of the topics that people talked about. Obviously, a lot of it had to do with the incoming U.S. administration and its impact on the mining industry, particularly from a regulatory perspective, as well as financial support that it may or may not provide, given some of the groundwork that was laid by the previous administration, and its overall attitude towards what I would say the energy transition megatrend. Another topic that was pretty hot for discussion was obviously the price of metals, battery metal prices, particularly copper, cobalt. I'm sorry, not copper, but cobalt, nickel, and lithium have seen quite a bit of a decline over the last couple of years, and that's impacting a lot of companies in a lot of different areas. So there was a lot of talk about where the metal pricing is going, what the demand expectations are going to look like. Sort of flowing out of that were discussions about the Chinese and the Indonesian and the Democratic Republic of the Congo governments and their actions in what I can only call a manipulation of metal markets. I've just named the largest processor of metals, the source of the next wave of nickel mining that's coming on board, which is Indonesia, and DRC, of course, controls most of the reserves for cobalt. So, these important metals that are critical for electrification megatrend, not just EV batteries, but well beyond that, are unfortunately in the hands of governments that are not above using geopolitical tools or using market tools to enforce their geopolitical will. So a lot of conversation about the onshoring of metal mining and processing, decoupling from China-centric supply chain, as well as looking for alternatives to Indonesian and Congolese metal supply. Capital access challenges, I mentioned them a little bit previously, but that was a topic of conversation. As metal prices get lower, companies' valuations get lower, the attractiveness of investing in a brand new deposit or brand new resource becomes more questionable. So there was talks about that as well. And then finally, regulatory environment. That's always a hot topic for conversation. Miners, they like responsible regulations that keep players honest and keep participants honest and make sure nobody cuts corners. But there was a lot of talk about, particularly in the Canadian side of the regulatory environment, there's just not enough people in these agencies to process all of the information that's coming at them and to handle all the projects that are being submitted. Not only is there a manpower shortage, but I've heard it more than once that there seems to be an expertise shortage by some of those regulators who are making these decisions not on the basis of any kind of economic or environmental rationality.
Right. You just made me feel old because I realized you and I were both writing equity research 25 years ago about DRC and cobalt, and it's crazy that that name still comes up.
Yeah.
So you have mentioned industry-specific topics as well as some higher-level geopolitical issues. Let's start with a bit of both, perhaps, Dmitry. I want to follow up on your comment about the rare earth elements industry, or REE as an acronym, as the topic has certainly been in the news a lot of late, particularly rather in diplomatic context. What is happening in the industry currently, and what do investors listening to this podcast need to know?
Sure. So let's talk a little bit about what REE or rare earth elements are. It's a column in the periodic table of elements. These minerals are probably the widest use for them is in magnets and manufacturing magnets. So to the extent that you have electricity and it's a source of power, but if you want to use that for anything more than heating up an incandescent light bulb or charging your power tool or your car, you need electric motors for that same car and for that same power tool. And electric motors are built on magnets, and you can't make magnets without REEs. Now, it has not been a very, I would say, top of mind industry or top of mind sector of the mining industry because China has controlled that industry for a long time. Many years ago, probably 3-4 decades ago, China in their Inner Mongolia part of the country found a very large REE reserve that contained several of these elements, was able to develop it very quickly, and given the size of the reserve and given the grade, in other words, the concentration of these minerals in these ores, they became the low-cost supplier and basically pushed everybody else out of the market. And people were okay with it for many years, certainly when the country was developing and going from strictly centralized control government or communist country to more market-based country or more market-based economy. They were very willing to develop this mine, get as much metal or as much mineral out as they could and sell it to the world. But probably about, and you may remember this, Tim, from our days in covering the chemical and material space, probably about 10-15 years ago was the first instance where they got into a political row with Japan and just banned exports of REEs to Japan and to other semiconductor manufacturers. At the time, it was Taiwan and Japan were the primary places where semiconductors were manufactured. And I forgot to mention, REEs also play a key role in semiconductor manufacture. And since then, they have been quite willing to use export bans or export restrictions to punish, if you will, countries or industries that seem to step out of line as far as they were concerned. So given all of that, and given the fact that people have been looking ever since that first trigger, I would say, 15 years ago or so, the first time the Chinese acted in this way, people have been looking for alternatives. They've been hard to find. These are not materials that are widely available, unlike lithium, which is you can find almost anywhere. It's just a matter of concentration. REEs are hard deposits to find. There have been some that have been found both in North America and Latin America and in Africa, and they're starting to get some attention. And capital to start developing. None of them are currently in production. I think the company that I spoke with that was closest to production was still like 2-3 years away. So this is not a near-term solution to Chinese control, but it is something that the world absolutely must move forward on. So there's a lot of excitement, as I said, in the REE market. I've never seen as many companies at the PDAC as I have this year. Usually there's been 1, 2, 3. There's probably a dozen RE companies, and I'm talking about companies, public companies with, let's say, 75 million and higher market cap. There was many more that were low double-digit market caps, which I really didn't pay that much attention to, other than speaking to them briefly. But they certainly seem to be better represented in the investor space, if you will. These companies are going public, and they're raising capital, and they're trying to develop their resources pretty aggressively. Excuse me. U.S., as you know, has been working with Ukraine over the last, let's say, month or so, trying to come up with an economic deal that would benefit both countries and provide some sort of security guarantee, or at least implied guarantee for Ukraine in its efforts to end the war with Russia. Ukraine happens to be one of those regions where there are a number of identified rare earth deposits. It's just a question of getting to them and getting the modern technology to them, which is something that the U.S. can clearly provide. And again, it would be a resource that would be independent of the Chinese supply chain and very much welcomed by the world. And the U.S. government has been very focused, not just through this trade deal that they're trying to do with Ukraine, but on the Department of Defense and Department of Energy loans and grant programs that were implemented under the last administration. These companies are starting to get some capital. Again, it's very early. Most of them are in discovery stage. Some are in sort of mid to late development. But as I said, the earliest one is probably 2 to 3 years away from production. But the talk is there, and the investments are pouring in. So it was good to see.
Great. Dmitry, if I put myself in an investor's shoes, my next top of mind question is pretty critical in my humble opinion. Prices of many metals and other materials going into lithium batteries have been absolutely hammered the last 2 years. How did people you talked to last week see the demand and price environment, both on short-term and perhaps medium-term time horizons? And then also, what effect, if any, is the current depressed pricing environment having on exploration companies' businesses and their prospects?
Sure. So as I mentioned, the 4 metals that have been most impacted were lithium, cobalt, nickel, and graphite. All of them have positioned themselves as battery metals. So all of them become closely identified with the EV industry, which is the primary driver of lithium alloy batteries. And obviously the EV uptake, certainly in North America and in Europe, has not lived up to expectations of as recent as 1 to 2 years ago. As a result, there's an oversupply of these metals in the markets right now. And after reaching a peak in the summer of 2022, the last 2.5 years, the last year and a half, pricing has come down pretty dramatically for lithium and graphite and cobalt as much as 90%, a little bit less so for nickel. Copper, interestingly enough, has shown some stability in terms of prices. It's still largely used as an industrial metal that has applications far beyond batteries, everything from piping in your walls to electrical motors to wiring in infrastructure projects. So there's been good industrial demand to support copper prices, but the other 4 have really come down quite a bit. And nobody I talked to expects a near-term rebound. Everybody acknowledged that what they saw in 2022 was a bubble driven by post-COVID tangled supply chains, where people were double and triple ordering just to make sure they had material on site when they needed it to. And as that unwound, you saw pricing come down pretty heavily. So people expect pricing to improve off of current levels in 25 and 26, not materially, but certainly in the upward trending direction. As I said, nobody expects to return to 2022 levels anytime soon. And a lot will depend on China's and Indonesia's willingness to continue to produce at a loss. One thing that we found throughout 2024, even as the prices collapsed for lithium particularly, Chinese producers continue to produce it, lithium carbonate and even lithium hydroxide, like it was still a high-priced metal. And economic considerations are not a big part of what drives these decisions. These are more political decisions. It's an effort to keep up, in my opinion, it's an effort to keep the prices low, to discourage development of new mines. And if that behavior continues, it's going to take a little bit longer for these prices to recover. Now, we have seen, some more rational behavior from Indonesia, for example, which is a major nickel producer. And I would say 70+% of new nickel capacity that's expected to come online over the next decade is going to be coming online in Indonesia. But they've set their nickel mining goals lower for 25 than they were in 24. So that should help. And we've seen DRC even put a ban on cobalt exports for about 4 months, trying to get the cobalt price up a little bit. Now, they're still producing cobalt because the production there is controlled by the Chinese, and that company is still pumping out cobalt, but they're putting it in the inventory. At least it's not available to the market, either on LME or the New York Mercantile Exchange. So, hopefully that'll benefit pricing, at least in the short term. But these types of, government-driven price manipulations don't have a way of lasting. So hopefully we'll get a little bit of a bounce off the bottom, but I wouldn't expect 25 to be significantly better than 24.
Got it. Yeah, something I want to revisit, not today on today's call, but we'll come back to, because I think we could have a whole podcast on this, Dmitry, is talking about how flagging EV sales are impacting demand, as well as I know a lot of manufacturers are trying to come up with alternatives to lithium-based batteries. But again, that's a topic for another day, but I think we could have a very interesting conversation there. So moving on, I know access to capital is just an ongoing challenge for developers and junior miners. Even major producers such as Albemarle are not immune from the effects of high CapEx requirements that the entire industry needs for growth. So having said that, what is the current appetite for investments in developers and junior miners from your perspective?
Yeah, that's a good point. It's tough out there. I'll be very honest. Low metal prices affect stock prices. Stock prices for miners typically are based off of a percentage of their net present value of that mine. And net present value is in large part driven by the metal price. So when the price comes down, net present value comes down, your stock price comes down, the discount to net present value gets greater. So it's a compounded effect. It also makes it much harder to raise capital. Now, the other thing that low metal prices impact is, and something that we should probably touch on here, I would say a lot of the easy gets have been gotten. In other words, a lot of the major mines and major deposits with high grades, in other words, high concentrations of these metals in the ore, have been discovered. There may be still some out there. I haven't come across any in my research into the industry that are as rich as the ones that are currently under development. But what we're seeing is lower and lower grade properties are getting capital. What that means is higher production costs because you're getting less metal for each ton of ore that you process.
Right.
It means higher cost of dealing with tailings and slag and waste disposal. So you're operating at a higher end of the cost curve with those mines. And again, with the Chinese and DRC keeping the price of these metals low, in my opinion, intentionally, is to discourage these lower grade reserves from ever being developed. They may be large reserves in terms of total metal contained,
Right.
but it also means a lot of waste product contained that you have to go through and process through. So as price of metal stays low and the economics of developing these lower grade resources becomes exponentially higher, it's more difficult to raise capital. And we've seen that, and we've heard that in the conversations in the halls of the conference. 2024, just by way of anecdotal evidence, 2024 was the lowest year since 2019 for private capital raises for developers and junior miners. Now, the good thing is that you got several government programs now that are stepping in and filling some of this funding shortfall, if you will. Again, both US, Canada, Australia, Europe is now having dedicated multi-billion-dollar funds looking to fund, and whether through grants or through loans, development of some of these resources. So governments are trying to sort of not replace, but at least aid with capital raises and take some of the place of what would normally be a private capital market by providing some government money.
Okay. And Dmitry, before we wrap up our discussion, I want to come back full circle to the geopolitical environment the industry is operating in. What were the two or three things that participants were particularly focused on or perhaps even worried about?
So I mentioned a couple of them previously. The Chinese rare earth ban, that's got everybody irritated. That is not just because it's rare earths, which is important metal, but that type of behavior is really putting people on notice. We've also seen China recently, well, it's a state-owned company, but in effect, China put our restrictions on export of lithium technology. A lot of lithium processing going from spodumene, or the mineral, to lithium carbonate and to lithium hydroxide has been developed in China, and they do have some proprietary technology as a result. There were efforts, by the companies that own this technology to export it out of China into their other international operations, and now that's being threatened. So, those types of actions have everybody on edge, and it just lights the fire under everybody to try to get decoupled from China as quickly as possible. Unfortunately, again, just finding the resources is going to be a 5 to 10 year program, and then you have to also build the processing plants to actually process those ores into usable material. So that was a big part of it. As I mentioned previously, Indonesia being a little bit more responsible here by lowering their nickel quotas for the year. Hopefully that'll do some positives for nickel pricing. The U.S.-Ukrainian rare earth deal got a lot of attention as well. One interesting thing that maybe a little bit of an aside is the current administration's more or potential for more constructive approach to deep sea mining. In other words, there's a lot of unconventional resources that are being exploited right now, or being looked at being exploited right now, including salt brines for direct extraction of lithium. But more importantly, and what I want to talk about for the next 2 minutes, is the deep sea mining of polymetallic nodules. Now, there are some, everywhere we look, we find these nodules. So it's not like they are scarce, but there's a high concentration of them in international waters. And there's a UN set up organization, International Seabed Authority, who was set up to put together a mining code for exploiting undersea seafloor in international waters. U.S. is not part of this organization, but they are an observer. But if you look at the at the people in the administration currently, whether you talk about Senator Rubio, who's now the Secretary of State, if you look at Stefanik, who is now a UN ambassador to the UN from the U.S., these have been champions of developing deep sea mining in the U.S. And I think with China becoming more aggressive in that organization as well, wanting to see those regulations put in place and wanting to secure themselves or avail themselves of this metal and these materials, I think U.S. is probably going to push a little bit harder to get those regulations done and allow the exploitation of that asset. So I think that's another thing that people have been talking about at the conference as well, at least the ones that are either directly or indirectly involved with that industry.
Great. Fun conversation, Dmitry, and it's certainly timely. I would be hard pressed to think of any week in the past year where either Wall Street Journal, CNBC, or Bloomberg, or all the above, haven't written articles about this pretty important topic of precious metals. So thank you for letting us glean insights into your key takeaways after attending PDAC conference in Toronto last week. And to read Dmitry's industry and company-specific equity research, as well as to access Water Tower Research's countless other small-cap equity research reports, podcasts, and fireside chats from Water Tower Research, please go to www.watertowerresearch.com.
Thank you, Tim.